That was an aside, but I think a useful one. Let's move on to Cooper Standard, because here's another one where people can get faked out of an unbelievable company at the exact wrong time because of price, which has nothing to do with value. The fact of the matter is, and honestly, I could have just replayed last week's podcast to deliver the message, is that everything, 5%, 5 stocks, 60% of the gains, anything that is cyclical, dividend paying, or has any debt on their balance sheet is trading like they're going out of business. And we even got an Ask Me Anything question last week about that. And I just pulled up their investor presentation from a few weeks ago, which we haven't covered yet because we did an extensive analysis on it a few weeks ago from the earnings call. Certainly they have the liquidity, $281 million. But what the person was asking was, oh, what about all of that debt? Which we've covered many, many times, but maybe they're new or maybe they just don't like to read, is that what you have here is we have no refinancing until 2026. And at that year, which is late in the year, I believe it's late in the year, is $43 million of refinancing. They're taking more costs than that out alone. The big refinancing comes in 2027. So if you, right now, this is what the stock market, but based on price, this is what the stock is saying. The stock is saying that over the next 2 years, car volumes will not go up. Their costs will not go down. They will not be able to refinance. Capital markets will be closed for 2.5 years. And therefore, the equity is effectively worthless at $11, which is basically what the market's saying. But if you actually get data and you look at car volumes over time, people see things in the exact reverse. So